Welcome to the Balance Sheet, where you rise above the noise and learn about the most important business issues of our time. I'm your host and fellow student, Conrad Chua. Dividends and stock buybacks have been used by companies for years as a way to return cash to shareholders. They're one of the things that you learn in Corporate Finance 101. Now, how does that theory play out in practice? And increasingly, why are tech companies using these instruments? Today, we have Professor Rau, the Sir Evelyn D. Rothschild Professor of Finance here at Cambridge Judge Business School. He's the founder and academic director of the Cambridge Center for Alternative Finance. Welcome, Raghu.
Thank you very much, Conrad. Thank you for inviting me.
So, Raghu, a very quick Corporate Finance 101 revision. What are dividends and stock buybacks?
Okay, so dividends and stock buybacks are approximately equivalent ways for a company to return cash to its shareholders. The idea is that every now and then, 4 times a year typically, a company would say, we are paying these dividends, so many dividends per share. They're usually paid out on a pro rata basis. So if you have more shares, you get more dividends. So every share gets an equivalent number of dividends within the same share class. In contrast, in a share repurchase, there are two types of share repurchases. One is a stock tender offer, where the company can target particular types of shareholders and buy their shares back. Maybe a blockholder wants to leave the firm. Maybe a blockholder is trying to sell his shares, and the company feels it's better off buying the shares from a blockholder rather than letting the shares be bought by a hostile bidder potentially. That's one approach. The other way in which a company can do share buyback is an open market share buyback, where it instructs its broker to just buy shares on the open market. So essentially, in both cases, you're returning money to the shareholders. In one case, to all shareholders through a dividend. In some cases, to particular shareholders, those who could sell their shares.
So, Raghu, what kind of company or at what point in a company's life cycle do they start thinking, okay, I can issue dividends or issue any kind of share repurchase? Would the company have?
Okay. The one thing about many companies is that when they're early stages of their life, when they're growing, they are investing in a bunch of internal investment opportunities. So at every point in its life, the company has to decide, these are the rates of return I'm earning on my investment opportunities within my firm. These are the rates of return which is costing me to raise the capital. So you're comparing the cost of capital with the returns you're earning on a particular investment. If you're actually investing at a rate which is lower than your cost of capital, you're actually destroying value. So the idea is that in an early stage, a company has lots of investment opportunities with high rates of return. It has relatively lower cost of capital, so it doesn't actually pay any dividends or make any share buybacks. However, when it matures, when it goes to a more stable, steady state, it says, you know what? By keeping that money within the firm, I'm basically going to be destroying value if I just invest in negative net present value opportunities, or even basically a negative net present value opportunity is an opportunity where the cost of capital is higher than the rate of return which you're getting from that particular investment. So at that point in time, the company may say, I may return the cash to the shareholders. Another reason for this is at that point in time, the company is generating a lot of cash, and cash is always a temptation for the managers. Spend it on perquisites, you spend it on corporate jets, you spend it on other things. So the idea is shareholders would like you to start paying dividends at a point in time when you're stable enough that you're throwing out a lot of cash.
And just very briefly, just to shout out to some of the viewers, we have Martin, I think he's from Toronto, Roxana's from York in the UK, Ray from India, and someone coming from London. We have someone local, Anka, here in Cambridge, and Matt, a recent alum from Chicago. So thank you, everybody. And if you have any questions for Raghu, please put them in the chat or comments. I already see one question, but we'll save that bit. So Raghu, are things like dividends and share repurchases, are they equivalent from the standpoint of the company in
From the
terms of returning
standpoint of the
cash?
company, yeah, from the standpoint of the company, they're exactly the same. Right? You're paying dividends to all shareholders, but there's a dollar amount or the pound amount of the dividends you're paying. You can also pay the same amount to some shareholders in the form of an open market share repurchase. But from the company's perspective, cash is leaving the company, so it doesn't matter whether it's leaving in the form of dividends or share repurchases. It's essentially exactly the same thing.
What about from the shareholders themselves? Do shareholders treat dividends or share repurchases in the same equivalent manner?
No, in that case, it's different. The reason is because dividends are taxed as ordinary income. In other words, when you are paying out a dividend, the dividends go to the bottom line of the shareholder, who then pays taxes on it. The share repurchase, in contrast, the only people who actually pay taxes are the ones who actually sell their shares back to the company. And that's if the share price has gone up from the price they purchased it. They pay capital gains taxes, which in some cases are usually lower than the ordinary income tax paid for dividends. So, from a tax perspective, the company would prefer to pay out its money in the form of share repurchases rather than dividends, because that way the tax accrued by shareholders is actually lower. The problem, of course, is if the government detects that you're regularly substituting share repurchases for dividend, it treats those share repurchases like a dividend. It says you're trying to just substitute a dividend by calling it a different name, and so you get taxed on the ordinary income. So companies typically don't have regular payments through share repurchase, but they have regular payments through dividends.
Hmm. Is it the case then that investors, once they're on a dividend program, they expect those dividends to continue?
Right. The idea here is something called signaling. So in classical finance theory, the story is that if a company, dividends are sticky, they act as a signal. So what that means is if a company doesn't have the money to pay dividends, if the shortfall of money is strictly temporary, what that means is the company will dip into its retained earnings to pay the dividends. And similarly, if the company makes a lot of money, it's not going to pay out a lot of money to the shareholders. It'll pay approximately the same level of dividends. However, if the company therefore chooses to change its level of dividend, shareholders treat that as a signal. What they basically say is the company is expecting a permanent decline or a permanent increase in their cash flows, and that's why they're committing to an increase of dividends or a decrease in dividends. And that commitment, the information effect, is what causes the share price to change. If the company pays the same level of dividends over time, temporarily dipping into retained earnings or putting money into retained earnings, that is because the investors, the shareholders think that the company is pretty stable. They don't need to worry about it. It's when dividends change that there's a perception that, okay, this company is either doing extraordinarily well, so it can afford to pay permanently higher dividend, or it's going to do extraordinarily badly, so it's going to pay permanently lower dividends.
We have a couple of questions. So first one, Roxana was asking that this taxation on dividends, is that UK specific? Is that throughout the world, the practice
It is
throughout the
what
world?
it is in most countries. Dividend income is usually treated as income taxes. In the US, for example, that's another example of a place where dividends are typically treated as income. There are very few countries which sometimes countries have announced tax credits. So I can think of a few examples where even in the UK, the government did announce a tax credit to bring dividends and share repurchases to the same level, but these have typically not lasted very long. In most countries in the world, it's pretty difficult to have dividends treated as ordinary income.
And actually, related to that question, I didn't realize that sometimes governments, when they detect these regular share repurchases, start to think, okay, that's a dividend. But how do they tax then? Do they tax all the shareholders as if it was a dividend? Do they tax the company?
That's a good question. It's almost never happened. So there are a few court cases in America where this did happen, where the IRS ruled that a company's distribution of dividends was in fact a particular. But there are very, very few cases, so I don't really recall exactly what happened. It's not a common occurrence because companies are very careful not to pay out the share repurchases very regularly. It's too dangerous.
Raj asks, there are companies which book a loss in a particular quarter or a particular time period, but they still continue to pay the dividends. Why do they do that?
Well, the answer to that is exactly what I was talking about a few minutes ago when I talked about it as a signaling effect. The key point is if the company is booking a loss in the current quarter and still continues to pay the same level of dividends, that's a signal to the market to say this book loss is temporary. It's not going to be a permanent book loss. Therefore, I can dip into my retained earnings and still commit to paying the same level of dividends because I know I'm going to make it up in the future once that book loss goes away. If there's a book loss in this continual quarter, and I expect that book loss to be permanently, there. That means consistently, quarter after quarter, I will be making losses from now on. I will cut my level of dividends, and that's a signal to the market as well. They will say, okay, this company is cutting the market. That's telling me that they cannot afford to pay the dividends anymore. That loss is likely to be permanent. So temporary book losses usually don't realize any changes in the level of dividends paid by the companies.
On the flip side, if let's say a company enjoys windfall profits in a particular term, etc., would they be tempted to change their dividend policy?
Okay. No, the company will not typically change dividend policy if it's just a temporary windfall profit, only for this one quarter. Sometimes, though, they may choose to pay out the money in what's called an extraordinary dividend. They're making it clear that this is not going to be repeated. I mean, this is out of the ordinary. That's why it's an extraordinary dividend. So I can make a one-off dividend for my windfall profits, but don't expect this going forward, is the idea.
I think that happens quite a bit with, say, oil and gas companies when, well, some geopolitical thing happens, oil price goes up, and then they do that. Yeah.
But they are very careful not to keep that as part of the regular dividend. They clearly mark it as not to be repeated extraordinary dividends.
This part about signaling, we've been talking about signaling when it comes to dividends, but I guess is there signaling when it comes to share repurchases? And it goes to Matt's question, which is, he asked, why is Apple doing, well, they started a few years ago, such large share buybacks? Couldn't they just have invested the capital? Or is this very much a signaling measure?
Right. One point is there is a signaling effect when it comes to share repurchase as well, but that's a different signaling effect. The reason that happens, usually when a company issues shares, when it does a seasoned equity offering, the share price falls. When it does a share repurchase, the price goes up. But it doesn't happen when the actual repurchase happens. It happens when the announcement that the company will do a share repurchase program occurs. Why is that happening? Well, one of the things is, if you think about a company which is currently trading for £100 per share, and the manager knows more about the true value of the company, whether it's £100, £200, £50, whatever. If the manager thinks that the true value of the company is actually £50, the market thinks it's worth £100. What should the market do? What should the manager do? Right? In this case, the manager should issue shares. People are willing to pay £100 for something he knows is worth only £50. So the moment the manager makes the announcement, they're going to issue shares, the share price will fall. It's not falling because there's an increased number of shares out there. There's not a dilution argument here. The key idea here is the market says, oh, why are these guys issuing shares? Because the manager thinks that the shares are overvalued. Same thing in the opposite direction. If the company is currently trading for £100 per share, but the manager believes it should be worth 120, what is the right thing for the manager to do? Is to buy back their shares. Why? Because now the company is signaling to the market that You're undervalued. That's why I'm buying shares which are worth 120. I'm willing to pay only, I'm getting it for £100. It's a good deal for my current shareholders. So in this particular case, Apple anyway is so profitable that for them, for their perspective, it's more on the sense of, we have to do something with the cash. They're literally, they have very few investment opportunities, I think, at the moment, where they can pump this money in. So in a way, it is also partly signaling, but I think it's also trying to say, okay, we are giving the money back to our shareholders because we believe that just this amount of money, not a huge amount of investment opportunities for us right now, which is a good thing because they're saying they're good corporate governance in the company.
Steve Jobs, very famous in his when he returned to Apple for his second term, he very famously said no dividends, no share repurchase, even though that cash was growing so rapidly, and I think a lot of shareholders were quite upset with that. Um, I mean, his philosophy was always cash is good because things could turn
Yeah.
south, and then we can use the cash and then save the company or something. And of course, he went through this period where the company almost went bankrupt, right? And he was ousted.
And he was
So,
fired, absolutely. Yeah.
how do you sort of reconcile some of this, where you think you want to be prudent, keep a good cash pile, at the same time keep these shareholders at bay, in a way.
Well, two ways. One way is a traditional finance way, which is say that you keep your firepower, you keep your powder dry. What that means essentially is even if you have a lot of cash, you never know when there might be an interesting investment opportunity arising. So, in other words, what happens is you are trying to keep, it's like a private equity firm, you're trying to keep cash on hand in case an opportunity comes along and you want to jump on it right away. For example, who knew 2 years ago that OpenAI would be so dominant? So maybe another company comes in, you want to jump in and buy it right away. So you keep that amount of money open. That's an option story. That is the value of waiting is high because you say the industry is incredibly volatile. We don't know when the next opportunity is going to come in. And therefore, the price of my option to keep my powder dry is actually pretty high because high volatility means high option value. That's a rational way of looking at it. But there is actually a behavioral way of looking at it as well. The behavioral way actually comes from one of my papers, which was published in the Journal of Finance. It also won the Ig Nobel Prize in 2017. But the idea here is what we were investigating in that paper was if you're moderate level of stress, but something that doesn't affect you personally, if that happens to you, you think, you know what, risk is okay because you took risk and it didn't hurt you personally. You take a lot more risk as a CEO. But if a bunch of risk has actually affected you personally, you say, oh, risk is bad, so I'm not planning to take any more risks. And you take much less risk when you become a CEO. So to give that classic example, one of the examples I use is actually Steve Jobs and Tim Cook. So what's stress? Well, in this particular case, in that paper, we said when you're growing up, stress is stress. You don't know what stress is. And specifically, what we took into account was something called natural disaster risk. That means if you think about Tim Cook was born in Mobile, Alabama. Tornadoes will rush to Alabama every year. Not a single tornado touched down. Nobody was hurt. Nobody was injured. So from Tim Cook's perspective, we had a lot of risk. We had, tornadoes. We had all these natural disasters happening. Nothing affected me. Risk is not that big a deal. In contrast, Steve Jobs, and I acknowledge this is a single cherry-picked example. Steve Jobs, growing up in California, there's a landslide near his house, 30 people were killed. So from his perspective, that stuff can happen at any time. You don't know what will happen. To add to that, that's his childhood experience, stuff which affects him formatively in his brain. But of course, when he was growing up too, Apple nearly went bankrupt, he was ousted, all these things happen. You need the cash. So you try to minimize risk by holding on an excessive amount of cash. And my paper basically says that actually has a genetic, a biological explanation as well.
I have to confess that I did not think about that connection, but that is really quite powerful. Yeah. And related to that, Roxana talks of us about whether there's this idea about diluting existing shareholders, um, and whether buybacks are an effective way to increase the share price. Do we see that happening with share repurchase? That, based on what you say, there's insider information. Do the markets actually work that way?
So, Matt, are you saying that you would to do so means what? To pay dividends or to buy back shares?
I
I'm
think
not sure.
Roxana is saying buybacks increase the share prices.
Okay, right. So the key to realize is the dilution argument doesn't work very well in a large liquid market. The reason is simple. When you buy back a share, you're reducing the number of shares, true, but you're also reducing the asset base, right? On the left-hand side of the balance sheet, you're using up cash to buy back an equivalent number of shares. So if you're buying the shares back at the market price, the amount of money you're reducing on the left-hand side, the asset side of the balance sheet, is exactly equal to the decrease in the number of shares times the price per share. So there is no effect on the price per share if you're buying back at the market price. Even if you're buying back at a premium, right? Suppose, for example, the current share price is £100, but the company announces they will buy it back at, let's say, 120. They're paying too much for the shares. They're paying a premium for the shares. So will that affect the share price? The answer is again, no. The simple reason is because if the share price is 100, but the company is offering 120, who will tender their shares? The answer is everybody. Everybody will immediately sell their shares. Unfortunately, the company only has a limited amount of money to buy back shares, so it will do a pro rata allocation from everybody. So what we have is that some of your shares will be bought back at 120. The remaining shares will be worth less than 120 or 100, but the average of the two will still be 100. So dilution is not a great argument. Right? It's basically the left-hand side and the right-hand side of the balance sheet will offset each other. So most economists attribute it more to information stores. So you're right, the buybacks are also a way to offer exits for some people within the company or institutional investors who want to leave, but the manager does not want to sell, doesn't want to let those block portfolios be bought by a potentially hostile bidder, so they would offer to buy these shares back themselves. So that would not all these, when they increase share prices, not about the number of shares in the denominator, it's about the information effects.
Mm-hmm. We have Nikant's question. What's the relationship between using money on dividends or buybacks or paying off debt that's costing interest?
So, well, it's a complicated question, right? Because I can give you multiple ways of doing this. So, for example, if you have debt that's paying interest, you don't necessarily want to pay off that debt, right? Because the beauty of debt is debt gives you a tax shield. You can reduce your taxes by keeping that debt. Right? So, if you're paying off debt and if your balance sheet is sufficiently healthy that your credit rating is not affected, I would keep the debt. It's reducing your taxes. However, the dividends and the share buybacks are a totally different reason. They're telling the shareholders, we're a strong company. That's why I can afford to pay the dividends. So in this particular case, I would say, it's totally reasonable to see a company both paying dividends or making buyback and keeping the debt on. So they're not necessarily trade-offs. These would only occur if you're financially constrained. That means, in other words, you have to do one or the other, but you can't do both. But a healthy company, not a problem at all.
Is this why Apple issued loads of debt years ago to finance their share repurchases?
For them, it's a no-brainer. They're a healthy company. They don't really care very much about the amount of debt they have. You can issue debt, get a tax sheet, and then use that to buy back shares. Helps the shareholders too. So information effects, tax sheet effects, everything that working in the same direction.
Isam, who's a recent alum, asked on LinkedIn, what's your thought on dividend recaps with the higher interest rate environment? He's personally skeptical with the higher cost of debt, but there are quite a number of people he works with who are still doing this.
Well, the higher cost of debt is significant if you're doing if you're financially constrained, right? If you're not financially constrained, then you don't have, it's not that big a deal in that sense. You're basically saying in some way, I'm getting a higher tax shield with even if the interest rates are higher, my tax shields are also higher. So it doesn't bother you that much. If you're looking at a dividend recap for a company that is financially constrained, that's basically, then you have a different situation. But then we have a very high cost of capital anyway for that. So I can see it in some circumstances, but not for a lot of large publicly listed companies. Again, it goes back to the question of, will the market give you money for a positive NPV opportunity? Think about a capital-intensive industry, which is easily seen to be a good company. Why will you have difficulty raising money when you need it? The only difficulty you'll have is if there's lots of asymmetric information. The market thinks that you are overvalued, but the market has no way to be sure. So that level of information asymmetry is what causes many companies to say, okay, you know what, I would rather pay off my debt, because that's called the pecking order theory of capital structure. They say, if you want to raise capital, you first depend on internal cash, then you depend on debt, and finally, you depend on equity, because the level of asymmetric information increases as you go down that line.
And Matt kind of replied to the question that actually all dividends returns capital, especially when there's like limited private equity exits.
Correct. Absolutely right. So in many cases, that's absolutely right.
I think historically, Silicon Valley has been kind of averse, or big tech has been averse to paying dividends. But recently we've seen Uber, Meta, they start to pay dividends. Is this a sign of Silicon Valley just maturing, big tech maturing, and they're playing by Wall Street rules now?
There's no Wall Street rules as such, right? It's more about the companies. Yeah, that's the idea, is essentially you're looking at these companies are maturing, they're starting to throw off cash flows. For Uber's case, for example, Uber is definitely signaling over here that we're basically, but they're not yet paying dividends, if you notice, because they're not committing to paying out a lot of money, right? They're not committing to paying out the same amount of money every year. They're just saying we do a share buyback, which is voluntary. You can choose not to do it. So what Uber's announcement is a kind of option. They say we have the right to buy back 7 billion worth of shares, but we can change our mind. A share repurchase is not a commitment. A dividend is a commitment. So in some ways, this is normal because you're trying to signal how healthy you are, but yet you're not you're not bound by it. You're not saying, oh, I'm committing to pay dividends. If Uber had said $7 billion worth of dividends, that would have been a totally different picture. Uber is saying, oh, we have enormous cash flow, but they don't, so you can't do this.
And I think that was the first, I think they announced this soon after they announced profits for the first time, or from a very long period. In contrast, you got someone like Meta, right, who announced dividends, and they saw, I think, a record rise in their share price. So again, is this the case where Meta is like saying, we've got cash, we see this consistent cash flow going forward?
Right, exactly. That's good news.
Yeah, and I guess this is also a a way to tell shareholders we're not going to be wasting money on the metaverse.
Exactly. Exactly. Like the virtual reality headsets or whatever Zuckerberg was really fond of.
Yeah. Of course, they could be wasting money on AI, but that's something else.
Absolutely. But AI is not being punished at the moment. So, in other words, the market is willing to give lots of money to companies which are investing in AI because that's the current hot trend. So, it's okay. But if Zuckerberg said we're going to double down on virtual reality, that would have been a bigger hit for the stock price.
So a lot of this is about signaling and the narrative that companies are trying to convince the market, isn't it?
Yes, correct. That's exactly right.
We have a couple of questions about debt, or comments. So Seka says that a company that he used to work for consistently took on debt to pay dividends. It was a very healthy company, so they were really doing this as a tax shield.
Yeah, that's one possibility. Yes, that's totally taking advantage of a tax sheet. It's also the case that by keeping dividends at the same level, you're also signaling that you are able to manage both the levels of debt as well as pay the dividend. Because taking debt is also a signal. Because what you're saying here is a different signal. The signal comes from the cost. So if you take on too much debt and the firm goes bankrupt, the manager will lose their job. So the manager is very careful not to take on too huge amounts of debt. And so taking on some level of debt is actually a signal in itself. You're saying, I'm healthy enough that I can afford to pay those interest payments over time. So you've got two types of signals. You've got dividends, which is a signal. You've got debt, which is a signal. You've got the tax sheet, which is a signal. All three go in the same direction.
Debasis is asking about at what point does debt affect the credit rating of the companies, the directors? How do the companies juggle those, those different things about like debt and then their own operations, I think.
I'm not sure what you mean by the credit rating of directors. Why would it affect the credit rating of directors? I'm not sure of your question.
I guess it'll be more about the companies themselves in terms of the credit rating, let's say, for debt.
Okay. Because remember the directors usually have liability insurance, so I doubt they'd be worried very much about this. But the company's credit rating is a factor of how much money. So you've got several factors. You've got the interest coverage ratio, you've got the leverage ratio, you've got a whole bunch of different types of investment ratios, return on investments, and things like that. And so the credit rating agencies consider all these factors when deciding whether your debt is sustainable or not. And companies are worried about that credit rating, but credit ratings are big, right? You've got AAA, you've got AA, you've got AAA minus, but there's a big gap. So if you're right to the top of your rating, you can raise debt all the way till you figure out at what point will you go to a lower credit rating when the cost of capital starts to go up. So in this particular case, the directors, the board of directors is the one who ultimately approves this. But I don't see why they would be sued, for example, if something like this happened. I mean, it seems to be more a company issue.
And are things like dividends and share repurchases another tool to ward off these activist shareholders?
Well, one of the things which the activists want you to do is to buy back their shares or, get rid of the cash. But activists usually go after companies which they think are badly managed. So the idea is essentially they say you want to spin off this division, you want to, pay back, you've got all this cash pile you're sitting on, that's just a waste of money. So in a way, the companies are doing exactly what the activist shareholders want. And so they say, okay, there's no reason for the activists to replace their board of directors with their own slate because you're doing what they want anyway.
And in the UK, quite recently, we've also had a lot of media scrutiny about things like dividends. And sorry, this thing doesn't quite show, but basically we've got all these water companies who have been paying dividends to their parent companies, which then pay off to shareholders. But those dividend payments or at least the media or government has been portraying that this has been done instead of investing in infrastructure. Do you see that kind of incentives playing out within companies like that?
First, the general idea is actually very straightforward. Right? So if you think about a company, these are called debt holder shareholder conflicts. And the idea is, if you think of a company which has, let's say, $100 million of assets, and let's say, cash, and no other assets. And it has debt and equity, but the interest payments on the debt are way too high, the company is going to go bankrupt. So what do the shareholders do? Pay themselves a massive dividend from that $100 million of cash, and then they declare bankruptcy. They say, okay, guys, the keys of the company are yours. Please, you can handle the company from now on. And they've taken away the money ahead of time. So that usually, if in a healthy company, that doesn't happen because the shareholders in most healthy companies basically get the increases in value coming from any investment projects. So when the company invests in an investment project, the bondholders get the same amount of money. It's fixed. That doesn't change. So the shareholders get the upside. But if there is no upside, you might as well take all the assets of the company and run. What about the UK water case? Well, that's actually interesting because that was caused by the government privatizing an enormous national public utility. And a situation like this, when companies bump in and out between public utilities and private companies, and the government can't really make up its mind the long term where it wants to be. I mean, I would probably expect that Labour will be confronted with this question when it gets into power. Should we renationalize the trains? Should we renationalize the companies and so on? From the shareholders' perspective, even if the company is healthy, you don't know if the next government coming in is going to change the status on you. They privatize it, but maybe they will nationalize it again. So if they do that, why not just steal the money? I mean, in a way, it's not steal the money. Why not just pay the money to yourself as a shareholder? Because that way, the money is yours. Right? The government can't claw back that money. And of course, if the company goes bankrupt, that's not your problem. The government will renationalize it anyway. So it's a sort of vicious circle. You expect the company to change their mind, which makes you more willing to take money out of the company, which makes the company more likely to fail, which makes the company more likely to be taken over by the government. So the circle is a very vicious circle.
So what sort of regulatory environment could help salvage this, or, well, not maybe not, but at least balance the kind of public service obligations of investing in infrastructure, making sure there's a vital public service that's being delivered, at the same time enticing your pension funds or the sovereign wealth funds to come and invest in the company and I would assume this has got to be a long-term investment. Right?
Correct. The key point is there has to be a very stable regulatory environment. And that's a problem. One of the problems in the UK and in the US, is not just the UK problem, is that the environment is totally unstable. Think about the US, right? Every Biden says they're going to do something. Trump comes in saying, I'm going to reverse whatever Biden did. This actually did happen. Obama put into place a whole bunch of rules. Trump changed all the rules. Biden changed it back again. Trump says he will change it if he comes back in November. The same thing over here in the UK. What happens when the government doesn't have a plan? Right? And it has to be a cross-party plan, and it has to be a plan that's stable enough that the business can plan for it. Because if I don't have any certainty about what's allowed and what's not allowed, I might as well take the money and run. I don't think there's a long term. So why do I want to just hang out waiting for a long term, which may never happen?
Vasu on LinkedIn asks, so for a company that is contemplating both dividends and buybacks, is there sort of a standard ratio? How do companies approach that division?
No, there isn't. It all depends on the particular company. It depends on the industry. Most of them, you really There is no number which you can point to and say that's a standard ratio.
Yeah. Okay. So, from the standpoint of the executives, or the CEOs, the CFOs, things like debt, dividends, you would think that's a way to kind of align their incentives, right, of management with shareholders. Have we seen evidence to suggest that's the case, or do they sometimes not monkey around, but have their own compensation linked to things like share prices, etc., and then that influences their own decisions about whether it's to have a buyback at this point?
That's true, it does. For example, a lot of tech companies, it's well known that the tax rates paid by the top people in America is actually lower than the tax rate paid by people like you and me, Conrad. So the reason, of course, is because if you're at the top, you do not take your money by cash flows from the companies. So, for example, think about Zuckerberg. He physically controls the company because he owns a significant portion of the controlling shares of the company, but he doesn't have much economic rights in the company in relation to the controlling level. So from his perspective, the question which Zuckerberg faces is simple. If I make the company pay out dividends, I will have a large income, which means I have to pay income taxes. If I pump into share repurchases, but I myself don't sell my own shares, what that means essentially is the share price of the company goes up, the value of the company goes up because I'm signaling my value, but I don't have any income. Right? It's just a share price. So how do I actually live? Answer, I borrow against my assets. So I go to the bank, I say, I have all these shares of Facebook or Meta, of Apple or whatever. Can I borrow on those amounts? And I finance my lifestyle about using borrowed money. That's not income, so I don't have to pay any taxes on that. So in effect, the compensation mechanism for many of these guys affects the policies they take, whether it's share repurchases or dividends. Share repurchases are better for them than dividends for the regular shareholders.
Well, thank you so much, Raghu, for giving us that insight into what happens around the board table when they decide every quarter what to do with their dividends or share repurchases. And I come out a lot more cynical than I was 45 minutes ago.
It's difficult to be too cynical when it comes to businesses and politicians, all right? So.
Yeah. And thank you very much for our viewers for the very engaging questions. And I see there's a lot of discussion in the comments, so that's great. The series will take a week's break. We'll be back on the 17th of May, the same time, when we'll look at what's happening in the world of e-commerce. Thank you very much.